Welcome to the Deep Dive. You know the drill. We take the raw data from earnings calls, stack it up, and give you the strategic takeaways.
Yep.
Today, we are diving deep into ServisFirst bank shares, that's ticker SFBS. They just had their Q3 2025 earnings call. It was on October 20th, right after the market closed.
And this is a perfect example for a deep dive because the headline numbers, they just lied.
Right. How so?
Well, you had management on the call and they sounded like they'd executed this masterful strategy, a huge push on margin expansion, on profitability.
Okay.
But the market just reacted violently. The stock, it dropped significantly in after-hours trading.
So that's the tension right there.
Yeah.
Our mission here is, I guess, twofold. First, we need to break down exactly where those earnings and revenue misses happen.
Right. What did the market see?
And then second, and I think this is more important, we have to analyze management's aggressive forward strategy. We need to figure out if they've actually built enough future earnings power to offset what are, very real credit fears that caused that drop.
Exactly. Let's figure out what they want you to focus on versus what the market just couldn't ignore.
So where do we start? The miss, I assume.
We have to start with the headline miss. That's what drove the initial panic. SFBS missed estimates pretty much across the board.
So what were the numbers?
The analysts, they were looking for adjusted earnings per share somewhere between, say, $1.34 and $1.38. The company delivered just $1.30.
And the top line, revenue.
That wasn't a small miss either.
Yeah.
Total revenue, so that's your net interest income plus other income, came in at $136.3 million.
And Wall Street was expecting.
Closer to 147, maybe even 149 million. When you miss by that much on revenue, especially for a regional bank right now, the reaction is just brutal.
Yeah, I saw that. We saw the stock drop, about 5%?
Yep, about 5% or $4 a share almost immediately in the first hour after the call started.
And that tells you everything. The market saw two things: the earnings miss and this unexpected jump in their credit metrics, which we'll definitely have to get to.
For sure. But before we get stuck in all the negative stuff, it's important to frame it how management did.
Okay.
They anchored their whole discussion around fundamental strength. So yes, revenue missed, but net interest income did grow year over year.
And the really critical one for a bank, book value.
Exactly. Book value per share grew robustly. It was up 13.3% year over year, ending the quarter at $32.62.
So they're generating capital internally. That gives them flexibility.
That capital strength is the key context because it allowed them to execute what I would call a pretty high-stakes strategic move this quarter, and it was all about profitability and their net interest margin, or NI.
All right, let's get granular on that NEM, because the numbers here are a little confusing on the surface. The reported NEM was 3.09%.
Right, but management basically said, look past that number.
Why? What was wrong with it?
It was artificially depressed. There was a non-recurring event. They had to take a one-time reversal of $4.4 million in accrued interest.
And this was tied to a specific problem loan.
A specific credit, that they moved to non-accrual status. So when you normalize for that $4.4 million hit, their actual underlying NIM was 3.19%.
319. So if we accept their framing, is 319 really that much better than last quarter? Or is this just standard earnings call spin?
No, this is where the numbers actually validate their spin. That normalized 3.19% led to net interest income that was sequentially $8.4 million higher than the normalized number from Q2.
Wow, okay, that kind of acceleration is huge in this environment.
Yeah. It's massive, and management used that point to confidently put themselves in the upper tier of regional banks. They cited an adjusted return on equity of 16.2%.
So that brings us to the engine behind this, right? The big, bold decision to reshape the balance sheet. This is the definition of taking short-term pain for long-term gain. Tell us about this bond restructuring.
It was an aggressive maneuver. SFBS strategically chose to sell $83.4 million of very low-yield bonds.
And how low are we talking?
These assets were only yielding them 1.66% on average.
Ouch.
And to get rid of them, they had to realize a $7.8 million loss right there in Q3.
And that $7.8 million hits the P&L immediately. That's one of the reasons the EPS number missed. But taking a loss like that on purpose suggests they saw a huge opportunity.
They absolutely did. They took those proceeds and, immediately reinvested them into new securities, yielding 6.14%.
Well, wait, so they went from 1.66 to 6.14?
Yep. Think about that spread. They instantly locked in a yield differential of almost 450 basis points. It fundamentally changes their future earnings power.
A 450 basis point differential is incredible. That move is like a mechanical guarantee of higher net interest income going forward.
And management was quick to point that out. The expected payback period for absorbing that $7.8 million loss is only about 3 years.
And there's a crucial timing element here for investors, right?
The most crucial part. This transaction happened late in Q3. We're talking the third week of September.
So the loss hit Q3, depressing the results we just saw.
Exactly. But the full juicy benefit of that 450 basis point yield pickup, that starts flowing into the P&L in Q4.
So they took the medicine this quarter to make the next quarter look dramatically better. And it had a secondary benefit too, didn't it? It helped with their AOCI.
That's right. For anyone who doesn't track every banking acronym, AOCI is accumulated other comprehensive losses. It's basically paper losses on your bond portfolio.
And it acts as a big drag on a bank's tangible book value.
A huge drag. So by selling these bonds and just realizing the loss, they cleaned up their AOCI balance. It's a key qualitative improvement that strengthens their balance sheet.
Okay, so beyond the balance sheet games, they spent a lot of time on just operational execution. Their efficiency and expense control were, I think they said, best in class.
And the numbers back that up. They're running a lean operation. The efficiency ratio improved dramatically to 35.22%. If you adjust it, it's 33.31%.
For a regional bank, anything sub 35% is exceptional cost control.
It really is. And the CFO made their goal very clear. They want to keep non-interest expense growth to only a fraction of their revenue growth.
And that discipline is clearly working.
One final detail on expenses: taxes. They used an investment in a solar tax credit, which actually lowered their effective tax rate for the whole year to 18.9%.
And they said they're going to keep looking for those opportunities, right, to keep the rate below 20%.
They are hunting for every single basis point of profitability.
Okay, so we've laid out the strategic strength, the profitability story. It's compelling. But none of that matters if the bank is ignoring major red flags in its credit portfolio.
Right.
So now we have to turn to the conflict that truly scared the market and drove that 5% stock drop, credit quality, and that spike in non-performing assets.
So starting with the big picture, loan growth was definitely below their own internal goals. They managed 7.9% year over year, which isn't terrible.
Right.
But they specifically called out that Q3 saw $500 million in loan paydowns.
$500 million in paydowns is a massive headwind.
Mm-hmm.
That tells you borrowers are either getting cautious or they're finding other financing.
That's the puzzle. But to counter that, management gave some pretty robust forward color. They emphasized that their loan pipeline in October was already 10% higher than September.
And higher than last year, too.
A full 40% higher than a year ago. So they're confident Q4 will deliver solid loan growth, since it's usually a strong closing quarter for them.
Okay, but let's address the elephant in the room. The metric that drove the fear: non-performing assets, NPAs.
Yeah.
NPAs as a percentage of assets jumped, and I mean jumped, to 0.96%. That's nearly triple the 0.25% they had a year ago.
And up sharply from Q2's 0.42%. I mean, that spike looks systemic. When you see a jump like that in 1 year, the market immediately starts to worry that the entire loan book is about to collapse.
And the net charge-offs were up too.
Also elevated, yeah. Annualized net charge-offs were 0.27%, mostly driven by these previously impaired loans.
So management comes on the call and insists this wasn't a system-wide failure, it was a contained event. How much comfort can we really take from that? What was the specific driver?
Well, the increase was almost entirely due to a single, very large relationship.
One borrower.
One borrower. It was a major merchant developer and rehabilitator of multifamily properties across Alabama, Louisiana, and Texas. This one relationship, which was made up of 8 separate loans, drove about $96 million of that total NPA increase.
So this is the classic regional banking headache. One bad apple makes the whole basket look rotten on the headline numbers.
Exactly. And management framed this not as a catastrophe, but as credit normalization. You know, just moving off historically perfect credit levels.
And what did they say to sued investors? What's the collateral situation?
That was the key piece of context. They said they secured substantial additional collateral from the borrower. They expect a full resolution over the next 6 months as the borrower is actively selling assets to pay down the debt.
And the loan to value.
Critically, management now believes the loan-to-value on that entire $96 million relationship is below 1-to-1.
Meaning there is equity protecting the bank's principal.
That's the ultimate backstop the market wants to hear. If the collateral is sound, the risk to capital is way, way lower.
This kind of ties into their whole risk posture then. We've seen a lot of ugly headlines about riskier lending practices at other regionals.
And management got ahead of that. They reiterated they avoid certain high-risk categories. They confirmed they have minimal exposure, just $71 million, which is less than 1% of their portfolio, to what's called NDFI lending.
Non-depository financial institutional lending.
Right. And they were specific about why they avoid it. They cited the higher fraud risk that comes with things like warehouse lending, ABL, and floor plans. They prefer their traditional model.
Lending to owner-managed companies and local real estate developers they know.
It's all about relationship banking, which historically is supposed to limit these kinds of systemic credit shocks.
Okay, so if we zoom out to the macro picture, their whole forward plan seems to rely on what the Fed does next.
It's heavily reliant on it. Since that bond restructuring was such a big move, we have to understand how they plan to leverage future rate cuts.
They mentioned they only got the benefit of that late September cut for, what, 2 weeks in Q3?
It's just 2 weeks. So looking ahead, assuming we get the anticipated cuts in October and December, they are targeting continued margin expansion of 7 to 10 basis points per quarter.
That is ambitious.
Very. And their whole strategy hinges on one thing: their ability to manage deposit costs down more aggressively than the amount of the Fed cut.
And they think they can do that because of their conservative deposit base.
Right. Beyond that, though, they have a massive internal lever to pull in the loan book itself, the repricing opportunity. This is embedded value that's coming no matter what.
How big is it?
It's a huge tailwind. They estimate about $2 billion of existing loans are set to reprice or cash flow over the next 12 months.
$2 billion.
Yep, that's split between $1.7 billion in cash flows at yields around 4.87%, plus another $300 million a year from covenant busts. That slow, predictable repricing power is a major counterweight to the immediate NPA fears.
And what about growth? Geographic expansion? They confirmed all their markets are profitable now.
They did. And for new growth, they specifically called out Texas. They have a strong interest in finding the right people to launch a Texas operation.
Which for a regional bank is almost non-negotiable for long-term growth, right?
Absolutely. It's an acknowledgement that they need to get into these high-velocity markets to keep up their aggressive growth goals.
So we have a quarter that's really defined by two clashing narratives. You've got management taking the short-term pain, that $7.8 million loss, to build guaranteed long-term NIM power.
A brilliant strategy, really.
Only to have it completely overshadowed by a headline EPS miss and a sudden huge spike in non-performing assets.
Even if that credit issue was technically contained to just one borrower.
The market reacted instantly to the fear. That NPA spike is now fully priced into the stock.
I think so. And what the market arguably hasn't fully valued yet is that guaranteed margin expansion, that 450 basis point yield differential they locked in, which starts paying off next quarter.
Which brings us to our segment. This is not financial advice. And we have to point out, SFBS's trailing one-year total return is currently negative 9.7%.
They are significantly lagging the S&P 500 and even slightly underperforming the regional bank ETF, KRE.
The stock is discounted. It reflects the current fear and confusion.
And that creates the classic setup for what we're calling the aggressive IM bet.
Okay.
The trade tries to capitalize on the fact that management has executed a mechanical, guaranteed improvement in future profit, which the market ignored because of short-term credit jitters.
So what's the action? How do you play it?
It involves setting up a long-term position to capture that payoff from the bond deal, but with a short-term hedge. So you'd buy long-dated calls, say 9 months out on SFBS.
That's the pure bet on the NIM power, right?
Yeah.
That the $7.8 million loss turns into higher forward earnings.
Exactly. And at the same time, you would sell short-dated puts maybe 30 days out at a strike price below the post-earnings low, because that action capitalizes on the fear premium from the NPA spike. The premium you get from selling those puts can then help finance the cost of the long-dated calls.
So the thesis is the credit issue is known, it's contained, and it's largely priced in. but the guaranteed mechanical margin expansion is a clear catalyst that the market hasn't fully appreciated yet.
ServisFirst is effectively banking their future on this margin strength. They're leveraging their capital position to outweigh the near-term volatility from this credit normalization event. They believe their execution will speak louder than the headline miss.
Management has a proven history of execution, especially on margin and efficiency, but the market is just demanding stability right now.
Totally.
And given that loan demand is still just okay and credit issues are normalizing off these crazy historic lows, you, the listener, have to monitor the resolution of that $96 million NPA relationship every step of the way.
That's the whole ballgame for the next quarter.
Exactly. Will they successfully resolve that single relationship and deliver on the next consensus EPS target of around $1.42? Or will the choppy sector force another round of conservative guidance? That resolution is the key metric.
Until the next deep dive, we hope you feel well informed.